Hello and welcome back to All Things Money. I'm your host, David Blain. Today's show, we're talking about the capital gains tax and how it affects different taxpayers. There were some changes that took place January 1st of 2013 in the tax code that alter how your capital gains will be taxed. If you missed the first segment, I went through and explained, exactly what capital gains are and things like that. Head on over to our website, dlblain.com. And we'll post the archive copies of the show there that you can catch up later. Also, if you got any questions on this, I know it's confusing, sometimes radio and TV, it's hard to get across. If you got any questions, feel free to just give us a call. Our number is 252-633-0107. You can also email us your questions at allthingsmoney@dlblain.com. And you can go over to the website. We got a big contact us button there at dlblain.com, and we'll be happy to take a look at your questions on this. Okay, so back to capital gains. As I was saying, the 0%, if your adjusted gross income, if your taxable income. Okay, so remember, you start with gross income. That's your salary and interest, dividends, capital gains. Then you subtract what are called adjustments to income, which would be things like contribution to contribution to IRAs, self-employment tax, self-employed SEP, 401ks, certain educational things, and you come down to what's called your adjusted gross income. If you look at page 1 of your tax return at the bottom of the 1040, that's your adjusted gross income. You flip over to page 2 of the long form. Then you get to take away your exemptions, basically a certain amount for how many people you have in your household. And then you subtract either your itemized or your standard deduction to arrive at your taxable income. Okay, so this is what we're talking about. If your taxable income is $72,500 and under, and you're married, your capital gains rate is 0. Okay? Now, I also want to we're talking mostly federal. Here in North Carolina, the North Carolina income tax rate maxes out at 7.75%. It gets there very quickly at about $100,000 of income. I didn't bring that chart with me, so you're going to have between, say, 6 and 8%, somewhere in there, of state tax. Now, North Carolina does not recognize any difference between capital gains or ordinary income, so when you compute your taxable income for state, it just throws it all in together. So you can add whatever we're talking about here, and I'll try to remember to do that, but whatever we're talking about here, you have to add your state income tax to this. Okay. So if you're married and your taxable income is between $72,000 and $450,000, your capital gains rate will be 15%. So that's a lot of you. That's a lot of the people out there in the listening audience. If your taxable income married is above $450,000, your capital gains rate goes to 20%. Okay, so that's capital gains rate. Now, there are other factors that come into play January 1, 2013 that can raise your capital gains rate as well. So let's talk about those. We've talked about these before. If your income is above $250,000, you get to look forward to the new 3.8% investment income tax. Another factor involved is what's called the Pease limit, and the Pease limit is named after Donald Pease, who put this complex formula in that limits your itemized deductions, which essentially adds about another 1% to your capital gains rate if you're married, filing joint above $300,000. Then we have the personal exemption phase out, which also will raise your capital gains rate if your income is above $300,000. So I know it's hard on radio and TV to get all these numbers. The point is that you have the stated capital gains rate of 15%. If you're below 72.5, it's going to be 0. But if you're above 72.5 but below the target amount of 400,000, 450 that sort of makes the headlines, you've got these three other taxes that could push your long-term capital gains rate, including state, into the 30%. We have a client who owns a company who's negotiating to sell it. We did a detailed tax analysis of this. So his long-term capital gains rate is going to be about 33%, including state income tax. That's a significant amount of money for capital gains for long-term. Now, short-term, your short-term capital gains rate is taxed at your ordinary income amount. So if you're in the highest tax bracket, which is now 39.6, you add on state tax, you add on the 3.8% investment tax, you add on the P's deduction, you add the personal exemption phase out, and you are well into the 50% range for short-term capital gains. So it brings up a couple things. Number one is for people out there day trading or short-term trading in your investment accounts, if you're buying and selling and trying to time the market, not only do you have to be right about the investment you're making, but let's say you're right and you generate this wonderful gain. It's a short-term gain, and if you're making a lot of money, those gains can be taxed well above 50%. That's a huge hurdle to make up if you're trying to beat, a more low trading type of strategy, a strategic asset allocation like we suggest, where you allocate your money strategically and rebalance as necessary, and only occasionally do you adjust your targets around. So if you're day trading in a taxable account, you've got a huge, huge hurdle to overcome. Now, of course, if you're making less than $72,500, a couple things. One, your tax bill isn't going to be that much. But number two, you probably need to be making some more money than that day trading, because you're not always going to be correct. Anyway, I don't want to get distracted on that. The point is that short-term capital gains above 50%, if you're doing something that generates short-term capital gains, you really need to rethink the strategy, because any gains you make are going to get eaten up by taxes. Well, that brings us to our second break. When we come back, we'll continue talking about some ways around this new capital gains tax.